Good afternoon. This is Cody Edwards from the Dickinson Law Firm, and I want to thank you for attending this webinar, Iowa Sales and Use Tax for Manufacturers. I've gotten a lot of requests for this because we initially did some webinars for contractors, and it seems like they were also interested in the manufacturing side of this as well. So we put this together specifically tailored for manufacturers. Like I said, my name is Cody Edwards from the Dickinson Law Firm, and a little bit about myself before we get started. Really telling you why you should trust what I'm saying today. I'm formerly an attorney with the Iowa Department of Revenue. Worked in the policy section. While I was there, I responded to policy letters from taxpayers throughout Iowa, and I helped to write administrative rules. So it's nice when I look research an issue, I see my name on a lot of policy letters, and I wrote a lot of the administrative rules that are effective today. After working for the Department of Revenue, I worked for a national accounting firm where I managed a team of state and local tax professionals. We focus primarily on multi-state tax issues, providing general guidance to taxpayers with multi-state tax issues and defending audits. Now I'm an attorney with the Dickinson Law Firm, and I lead the state and local tax practice group here. The group provides legal services related to sales and use tax, income tax, and property tax. We provide general guidance on state tax issues. We help clients when the state audits them for sales and use and income tax, and we help clients with their property tax appeals. The agenda today will talk about Iowa sales and use tax generally, Iowa's manufacturing exemptions, general exemptions, sales tax nexus, what we should do going forward, and we'll leave time for some questions, hopefully. There is a chat feature, and if you have questions throughout, you can ask questions through that chat feature, and I'll try to hit them as you ask the questions, but I can also take questions at the end. Before we get going, I really want to really explain what sales tax and give you an easy way or an easier way to think of sales tax. I think of it as an onion, right? So there are numerous layers, and a lot of these concepts are complex, but you just have to peel back the layers one by one. Sales tax is also like an onion because a lot of the times it makes people cry. Lucky for me, onions don't affect me, so it works out quite well. All right, let's get started. Sales and use tax generally. All right, let's start with the very basics here. Sales tax is the tax imposed on a sale of tangible personal property and services. Sales tax, very basic. It's what you pay on purchases unless it's exempt, and this is what you charge on your sales unless the person to whom you're selling it is exempt. Use tax is what you have to pay if you are not charged sales tax, but the item is subject to sales tax in Iowa. You remit use tax. The state puts the burden on you. Generally speaking, use tax shows up on your internet purchases or on services where the service provider does not know that the service is taxable and doesn't charge you tax. Local option sales tax. Local option sales tax is the extra 1% tax that many jurisdictions charge. And I bring this up primarily because on audit, the department, on use tax audits, the department takes the position that if you purchase something for which use tax is due within a local option jurisdiction, that you also owe the 1% local option sales tax. Now, the statutes are very clear that there's no local option use tax, but the department disagrees I've raised this issue numerous times, and hopefully we can get it resolved in the near future. But I think it's very clear there's no local option use tax. And I mention this because you may think it's the local option tax is only 1%, but if you have $1 million assessment, 1% of $1 million is a big number. It's $100,000. So this issue is one that should be raised if you're audited for use tax. All right, a little more basics here. In Iowa, tangible personal property is taxable unless it's specifically exempt, and there are exceptions from the exemptions. And we will see here the manufacturers have a nice set of exemptions from their purchases of tangible personal property. And there are over 100 exemptions generally. I think there are about 13 to 14 that apply to manufacturers. Services in Iowa, services are non-taxable unless they're specifically taxable. There are exceptions from taxation. We'll talk about those. In Iowa, we have the big one that applies to manufacturers is repair services are subject to tax. We'll get into that exemption a little, the exception from that in a little bit. Iowa also taxes lawn mowing, but not snow removal. They also tax reducing salons and Turkish baths. So I think that exemption should be updated. We'll see if the legislature ever does that. Sales and use tax returns. Iowa is one of the few states that has a separate sales and use tax return. You need to file both, and the reason you should file both is due to the statute of limitations for audits. The statute of limitations is really the time that the department can look back and assess you for underpayment of tax. For non-filers, the Department of Revenue has an unlimited amount of time to audit you. So if you don't file a use tax return, the department has an unlimited amount of time. In practice, that's limited to 10 years. If you do file a return, that look-back period is limited to 3 years. And I've seen enough of these audits, the 10-year audits, to know that if you are in a 10-year audit, the penalty and interest associated with that is about generally between 60 and 75% of the tax liability. If you are not currently filing a sales or a use tax return, and you want to, I would urge you to consider filing a voluntary disclosure agreement if possible. By filing a return that you haven't historically, that may raise a red flag. So by filing a voluntary disclosure agreement that limits the look-back period that the department looks back, it halves it. So if it would have been a 10-year look-back period, they would look back 5 years. So something to keep in mind if you haven't filed a sales or a use tax return and you want to going forward. All right, let's talk about Iowa's manufacturing exemptions. These are the 9 manufacturing exemptions that are specifically applied to manufacturers. Machinery exemption, replacement parts, supplies, and computers. Used in processing by a manufacturer, services used in processing, property used in R&D, property used to maintain environmental conditions, fuel used in exempt property, services for design and install of new exempt property, chemical solvents, sorbents, reagents, gases used in manufacturing, and pollution control equipment. Some of those, the ones with the asterisks, are the ones that must be directly and primarily used in manufacturing or in processing, and that makes a lot of difference on the scope of the exemption, and we'll get into the details of these as we go forward. All right, let's start with the machinery, equipment, and replacement parts, supplies, and computers exemption. This is the major exemption for manufacturers, as this type of property makes up a large amount of their spend. So under this exemption, the sale of computers, machinery, equipment, replacement parts, and supplies are exempt if they're directly and primarily used in processing by a manufacturer. So going back to this onion analogy, I look at this exemption and I see 5 layers, right? So the 5 requirements here are that what's being purchased has to be a computer, machinery, equipment, replacement part, or a supply. The second layer is that it has to be directly used in processing. The third, it primarily has to be used in processing. The fourth is that it has to be used in processing, whatever that means. And the person buying it has to be a manufacturer. So the threshold question here in this exemption is, what is a manufacturer? And this is an interesting issue because manufacturers, or this exemption is so broad, a lot of entities are trying to fit within the definition of the manufacturer. So the statutory definition is any person who purchases, receives, or holds property of any description for the purpose of adding to its value by a process of manufacturing, refining, purifying, combining of different materials with a view towards selling the property for profit. So that seems relatively broad, and the definition of manufacturer was litigated in 2010 in the Sherwin-Williams decision. The department, well, I guess the history of this is Sherwin-Williams wanted the paint mixer in its retail stores to be exempt. And you think you know the machine where you buy the base and then you add your tint to it and then it shakes it up. That was what they wanted to be considered as exempt machinery and equipment. The department rejected Sherwin-Williams' contention that it was a manufacturer because it said only taxpayers who are primarily engaged in manufacturing are eligible for the exemption. This was appealed all the way up to the Iowa Supreme Court, and the Supreme Court said it is not absurd to provide a retailer a manufacturing exemption when the equipment is used in the same way as the manufacturer would use it. Under this, the manufacturer does not have to be primarily a manufacturer, and you have to look at this on an equipment by equipment basis. The Department of Revenue has yet to adopt new rules, and their position is still that a manufacturer must be a principal business, must be manufacturing. In the wake of Sherwin-Williams, it should be noted that retailers such as bakeries, grocery stores have been filing large refund claims for their ovens, their meat cutting equipment, their refrigerators, things like that, based on the Sherwin-Williams decision, and the Department of Revenue has rejected those refund claims. There is proposed legislation at the Capitol this year that redefines the manufacturer as an entity that's ordinarily thought of as a manufacturer and primarily a manufacturer, and the definition of manufacturer excludes retailers and contractors. Now, if you think about this, it's fairly interesting because by proposing this, one would argue that under Sherwin-Williams and the current statute, retailers are indeed manufacturers and would qualify for the manufacturing exemption. So the question would be, even if this doesn't pass, will the Department of Revenue pay out these refund claims based on Sherwin-Williams? And I guess that's to be determined. So manufacturer, pretty much you look and see if you're mixing or combining things, you probably are a manufacturer. But just know if you also are a retailer, you may get some pushback from the Department of Revenue. This is the slide that really just shows what the Department of Revenue's current interpretation is. I don't want to beat this up too bad, but the entity that makes the Wonder Bread is a manufacturer under the department's current view, but the bakery down the street is not. So the oven used at the Wonder Bread factory is exempt from sales tax, but your baker's oven is not. Same with those hamburgers that you pick up at your local convenience store, but your burger you buy at your restaurant down the street is not. Then the hoagies, we have the same concept. There's actually a policy letter that says Jimmy John's is not a manufacturer. All right, so let's get to the other layers of this machinery and equipment exemption. Primary use, very straightforward. 50.1%, usually pretty clear. So you have to use something 50.1% in processing for it to be exempt. That's not challenged a whole heck of a lot. Direct use, used to initiate, sustain, or terminate an exempt activity, a lot of times based on facts and circumstances, and we really have to look at the scope of the processing exemption. One thing to note here is direct use. The department used to take the position that many items were not directly used in processing because it was one step removed, but as we'll see later, it seems like the Department of Revenue, through legislation and policy letters, has really stepped back from this one step removed concept. Processing is another layer of this exemption. It's a series of operations in which materials are manufactured, refined, purified, created, combined, transformed, or stored by a manufacturer, ultimately into tangible personal property. This is really just defining in what process do you have to use your machinery and equipment in order for it to be exempt. And it really begins, processing really exempt, it begins when you receive raw materials and then when the finished product is delivered for shipment. So processing starts when your forklift takes the raw materials off of the truck, and then it ends when it's shipped off. So any machinery and equipment used in processing would be exempt. Processing also includes quality control, testing finished products, building shipping containers. So really anything within that manufacturing floor should be part of processing. Okay, so let's define machinery, equipment, replacement parts, and supplies. This is obviously what you're buying. If you go through the other layers, are you a manufacturer? Is it primary use? Is it direct use? Is it processing? Then you look and say, all right, what am I buying? Am I buying machinery, equipment, replacement parts, and is it exempt? So the definition of machinery is pretty broad. Any mechanical, electrical, electronic device designed and used to perform some function and to provide a certain effect or results. You read that, that's quite broad. Machinery also includes attachments to the machinery. So this would be maybe a computer used to run the machinery. One thing to note here, and this gets back to my one step removed comment earlier, is LP tanks to power forklifts. So clearly your forklift used to transport goods in the manufacturing process would be exempt from sales tax. We'll talk later. The fuel to run that, the propane to run that, is exempt. But there is a question about whether the tanks to power the forklifts are exempt. Historically, the department has taken the position that that's one step removed from the machinery and from the process, but arguably that's an auxiliary attachment to the machinery that the machinery couldn't run without. They have recently come out with a ruling that generators to power the exempt machinery is exempt, but that would seem to be one step removed. So maybe the propane tanks are now no longer one step removed. Equipment, devices or tools used to produce final products or achieve a given result. Once again, this is very broad. The example of an equipment is a table used to assemble products. An exception from this is that equipment does not include hand tools that are powered by human effort, This may be exempt as a supply, as we'll talk about shortly. I really have a difficult time determining between machinery and equipment, and I don't think the analysis there is that important. But historically, machinery has been something that is mechanical, like a lathe or a press, and equipment is something not, like a table. Once again, it has to be directly and primarily used in processing. One recent development for machinery equipment is the definition or examples of the machinery and equipment, and the examples and the new rules are that coolers and storage tanks are now machinery and equipment. Historically, storage tanks have been treated as real property for purposes of contractors installing them. But now that we have this rule that says storage tanks are equipment, that leaves us in a tough spot. So what I think about, or the issues I see here, is that a storage tank for purposes of a manufacturer is now tangible property and exempt, but the same storage tank for a farmer would be real property and taxable. So for example, if you're a manufacturer that stores grain in a grain bin, arguably that storage tank could be treated as tangible personal property under these rules, but under the farming rules and the contractor rules, that would be treated as real property, so then the taxation would be different. So just something to keep in mind, something that we'll need to iron out eventually, but just keep that in mind. As a manufacturer, likely exempt. Replacement parts. Cost or useful life is no longer a determining factor. Historically, the department's position on this was that if the item cost $500 or more, it was a replacement part, or if it had a useful life of longer than 12 months, it was a replacement part. Proving that was overly burdensome, and the administrative rules and the statute, I believe, would have been amended to state that cost or useful life is no longer a determining factor. 3 criteria for replacement parts. Replace a component of an exempt item and be removable from the exempt item. Performs the same or similar function as the component replaced, and it restores operational condition or upgrades or improves efficiency. Examples of this: bearings, brakes, belts, things like that. You may have something that's added to the machinery and equipment, and that's not a replacement part, that doesn't replace an item. Likely not an exempt replacement part, but likely an exempt auxiliary attachment to the machinery and equipment. Supplies. This is a big one. This is effective July 1, 2016. Supplies used by manufacturers are exempt. The rationale here was that these are being used to produce the final product, and they should be exempt because the sales tax just is passed on to the consumers through the increased price. The first 3 bullet points there are relatively straightforward. Saw blades, drill bits, filters, jigs, dies, tools, cutting fluids, oils, lubricants are now exempt as supplies. Interestingly, water. If water comes into physical contact with the tangible personal property used in the processing of the final product, that water is exempt. That's by administrative rule. The final bullet there: tangible personal property that is exempt, that is directly and primarily used in processing, maintaining integrity of environmental conditions, R&D or recycling, and pollution control. That's a new one, and the way that's interpreted is, I think we're still trying to figure that out. The examples list prototypes and testing materials that are used in research and development. Historically, though, those items were according to the Department of Revenue, taxable. There is a case out there that will decide this, but that was historically the Department of Revenue's position. But now this broadens the scope of the supply exemption. Examples of this would be shoe covers, latex gloves, hairnets, things like that historically were taxable supplies. Going back to the equipment, where equipment does not include hand tools, this definition of supplies here is broad enough that it may encompass hand tools, and I think there's a fairly good argument that even though hand tools are not equipment, they could fit within the supply exemption here under this fourth bullet point. That one is currently being that issue is currently being figured out, but there is certainly good support that hand tools could fit within this supply exemption. Okay, that's one exemption. We only have 12 more. The next one here is services used in processing. And we were previously talked about machinery and equipment used in processing. So now we're going to switch over to the services side. And this one's a little tricky, but I think you just have to, like I've said before, peel back the layers. For this exemption, there's a distinction in the definition of processing between a manufacturer of food for human consumption and a non-manufacturer processor or a non-food manufacturer. So let's start with the exemption for food manufacturer. Under this exemption, carbon dioxide, electricity, steam, and services are exempt if it's used in one of those 7 manners. A couple things to point out here. The first bullet point under the carbon dioxide, where it says used in treatment of materials that changes its form. Interesting to note here that unlike the other processing exemption that we'll talk about in a minute, this requires treatment and not special treatment. Non-special treatment is simply washing and sorting of eggs or agitation of liquids. So electricity or services used in these activities would be exempt. Non-food manufacturers require special treatment. Interestingly, rental of tangible personal property under this rule is treated as a service. So services are exempt. So if you rent something, it's treated as a service, and therefore it's exempt. The big issue here is rental of uniforms. That would be taxable unless it was treated as a service under this rule, and it is treated as a service. So rental of uniforms is exempt. Janitorial services are exempt, and we'll talk about repair services here. A couple of the big issues to point out here is this has to be food for human consumption. So we can all assume, okay, human consumption, that seems like a relatively simple concept. But the issue is, what is food under this regulation? So does the food need to be in the final form? So does it need to be the jelly beans that you're eating, or can it be the high fructose corn syrup that's eventually going to be put in the jelly beans? I think there's a pretty good argument that it can be the high fructose corn syrup that's going in the jelly beans, but that one's not resolved. At least through case law, it's not resolved yet. The second issue, or whether the services used to repair the machinery and equipment by a food manufacturer are exempt from tax. So I think there's a fairly good argument that the services used to repair the equipment should be exempt. The department says no, last I've heard. The statute, first and foremost, does not require direct and primary, so it merely requires that the service be used to maintain the integrity of the food, or used in maintenance, or used in sanitation. And if you read the rules say that services used in pH meters, incubators, pumps, conveyors, and forklifts are exempt from tax. So really, what does that mean? To me, that means any services used to repair those items should be exempt from tax. That's the position that a lot of folks take, but be forewarned that the department may take another position. Okay, services used in processing by a non-manufacturer, processor, or non-food manufacturer. So the definition of processing for these types is a lot more narrow. So it exempts electricity, steam, or taxable service if it's used in the operation which subjects raw materials to special treatment. So that's the definition of manufacturing, is that one bullet point. If you look back here, we've got those seven bullet points that make up the definition of processing, and we don't have carbon dioxide over here. So special treatment, that's sanitizing products, that's subjecting raw materials to special treatment. So that's bending steel, or making a widget, or welding something. That's special treatment. This is different, that you need not be a manufacturer. So this could apply to restaurants, bakeries, grocery stores. So that would mean that their electricity to power their ovens would be exempt from tax. Under this one, electricity used to freeze, say, ice cream, for example, would be exempt, but electricity to hold the material is not exempt. And that would be in a non-manufacturing setting. Okay, like I said, these are layers. So we have the manufacturing, machinery, and equipment exemption. That's for the tangible items, and then we have the services used in processing exemption for services. So you have to first decide, are you a manufacturer under the M&E exemption, and then you have to decide if you're a manufacturer under the services exemption. And if you're a manufacturer under the service exemption, then you look to food versus non-food. I understand that was really heavy stuff, so everybody likes kids and teddy bears and dogs, so let's just take a minute and look at these cute kids and dogs before we go on. All right, let's move on to the light stuff. These are miscellaneous manufacturing exemptions that apply. These are relatively straightforward. Property used in research and development must be directly and primarily used in R&D of new products or processes of producing products. So if you make widgets, if you're researching how to make a new widget, that would be exempt. Or if you're researching a new process to make the same widget, the machinery and equipment, replacement parts, computers would be exempt as well. Property used by manufacturer to maintain integrity of environmental conditions. This is really property used, maybe this is a cooler that's used to store your final product, or a room that has a certain amount of humidity to store your products. That room or those walls would be exempt if they're equipment. And really the distinction here is, are you maintaining the environmental conditions for the property being produced, or is it for comfort of your workers? Fuel used in exempt property. If the item's exempt, it's the fuel used to power it should be exempt as well. One thing to mention here is that the services used in processing exemption that we talked about earlier says that electricity is exempt only if used in changing the context, form, or product of the material. But this really expands that fuel exemption to all machinery and equipment that's exempt from tax. Services and design of installation of new industrial machinery and equipment. this applies to new equipment, so it has to be new. It can't be rebuilt equipment, and it can't be bought from somebody at a garage sale. It has to be brand new, and it's industrial machinery and equipment, which does not include computers and replacement parts. But as we talked about previously, installation of replacement parts could be exempt under the services used in processing exemption. More miscellaneous exemptions. The first two, I think, seem to be a bit redundant now that the definition of supplies has changed and supplies are now exempt. So the top one, chemicals, solvents, sorbents, and reagents, those are exempt if directly used and consumed in processing of tangible personal property. But I think under the supplies exemption, these types of tangible property is exempt anyways. Gases used in manufacturing, same issue. Probably a supply now, but interestingly, the oxygen, hydrogen, methane, and non-inert gases are taxable under this rule, but I think the supplies exemption exempts the non-inert gases. Pollution control equipment used by the manufacturer. The equipment has to be used for the primary purpose of reducing, controlling, or eliminating air or water pollution. There are the examples. This does not apply to noise pollution, so it has to be air or water pollution. All right, let's get to some general exemptions here. Packaging. Packaging is exempt if it goes out with the final product. So pallets, plastic wraps, straps, anything that goes out with the final product is exempt from sales tax. Property used in recycling. The product or the item has to be directly and primarily used in recycling or reprocessing a waste product. And unlike the manufacturing exemption, this doesn't require the sale of the waste product. So any sort of bins you have at your facility that is collecting waste that is then going on to be recycled would be exempt from sales tax. The recycling begins when the waste products are collected, so that would be your bin, and then it ends when the products are in the form of the raw materials or non-waste products. So this would be, say you're turning trees into mulch. The waste product would be trees, and then the mulch would be the finished product, and the recycling ends when the mulch is complete. This is a little broader than the manufacturing exemption, that it does apply to on-the-road vehicles or licensed vehicles. So the recycling companies around town that have the big recycling trucks, those recycling trucks are exempt from tax if they're primarily used in recycling. One thing to note here is that historically this is only applied to the machinery and the equipment used in recycling, but that has since been expanded to include replacement parts and supplies. Casual sale exemption. This is an exemption that, for simplicity's sake, let's say, makes it so you guys do not have to pay sales tax if you go to a garage sale. If the entity from which you're buying the property is selling you something, but they're not in the business of selling that item, such as if you purchase a company and it's an asset sale, you don't owe tax on those assets. Or if, say, you buy a lathe from another company and that company sells widgets, that would fall under the casual sale exemption as well. So most of those items you purchase would probably fall under the manufacturing, machinery, and equipment exemption, but just another way to attack an exemption, or another layer of exemption there. Computers. You probably noticed that in the machinery equipment exemption, I didn't talk about computers, and that's because there's really a misconception about the computer exemption, and that the computer has to be used directly and primarily in manufacturing. It doesn't. So the computer exemption applies to computers used in the accounting department, in your CFO's office, and it does apply, obviously, to the manufacturing process. But it's a very broad exemption that applies to all the computers that are used by a commercial enterprise. So the question is, what is a computer? That seems fairly obvious, but the computer is the computer unit itself and anything attached to it. So a monitor, copiers, printers, scanners, things like that. But this computer exemption has continued to expand. So it is your computer on your desk, but it should be your tablet, it should be your cell phone, and we're just kind of waiting to see how this definition evolves, because it has been evolving, because all a computer has to do is process data. In 2010, a court held that a slot machine is actually a computer, for purposes of Iowa sales tax. Remember these exceptions to the exemptions that I talked about. The court said, yeah, this is a computer, but because there's an exception for point of sale equipment to the computer exemption, the slot machines are not taxable, are not exempt. So there you have it. A slot machine is a computer. I always joke, is the Tesla that you just bought a computer, and should it be exempt from tax? That's kind of the extent of the computer exemption. One thing I say is, when in doubt, consider the computer exemption. So if you don't know if something's taxable or exempt, does it have a computer chip in it? It likely qualifies for the computer exemption. Electronically delivered property is exempt. This includes software, books, music. That's electronically downloaded. For software, I know a lot of times you get the option of receiving a backup disk, and I would highly recommend not taking that backup disk, because that backup disk taints the entire transaction, and then the software becomes subject to sales tax. For software, keep the proof of the electronic delivery in case of an audit. And then proposed legislation. The state has an issue with, and I think they are right here, that a book that you buy from your local store is subject to tax, but if you buy that same book on the Kindle, it's not subject to tax. So what they've done, they've proposed legislation where pretty much all digital products are going to be subject to sales tax, but there's a business-to-business exemption. So if this is passed, the businesses still will not have to pay tax on these digital products. With the proposed legislation, taxation of information services are subject to tax. This would be any sort of research tools, call it a tax research tool or a law research tool. But there again, business-to-business exemption applies. So if you're a business that qualifies for the computer exemption, you would also qualify for an exemption for the taxation of the information services. Okay. That's it for our exemptions, and certainly feel free to ask questions about those. I think I went through those pretty quickly, but the information is there, or you can always call or email to pick my brain on those. The next issue is sales tax nexus, and nexus this kind of answers the question, when do I have to charge sales tax in another state? And the current law is you only have to charge sales tax in another state if you have people or people there or a physical presence. So this was based on the 1992 case, Quill v. North Dakota, and essentially says you only have to collect sales tax if you have a sales force, plant, or office within the state. So that's the current lay of the land. In 2015, there was a case not having to do with sales tax nexus, but Justice Kennedy, in his concurring opinion, said it's time to reconsider the court's holding in Quill. And the states got very excited about this, and I think at least 11 proposed what we call economic nexus laws that say even if you don't have physical presence in this state, you have to collect sales tax if you have $200,000 in sales or 200 separate transactions, or there are numerous iterations, but that's an example of a law. The goal of that was that they were going to be appealed all the way up to the Supreme Court, and the Supreme Court would take the case, and that indeed happened. So on April 17th, we will have there will be oral arguments to decide this issue, South Dakota v. Wayfair, and hopefully we can get resolution with this. There are numerous thoughts on the way this is going to shake out. One is that the court's going to say, hey, this is well within Congress's purview and they need to make this decision. Or they could go the complete opposite and say, all right, if you make one sale within a state, you have nexus. That's not likely. A lot of folks also don't think that the Supreme Court's going to say it's up to Congress, but it'll probably fall somewhere in the middle. We just don't know what that's going to look like yet. There's proposed federal legislation that's been out there for quite some time, neither of which has really moved. Marketplace Fairness Act repeals Quill and says if you meet a certain amount of standards, you have to charge tax in the state, or the No Representation Without Representation Act, and it codifies Quill, saying you have to have physical presence. Here's a shameless plug for an article I wrote for the American Bar Association. It will tell you everything you need to know, probably more about the whole economic physical presence issue. All right. Going forward, more shameless plugs here. So we did cover a lot, but if you want to reach out, I provide general advice and planning. If you are going to be affected by if the Iowa legislature redefines what a manufacturer is, there are certain ways that you could get around that rule of being primarily a retailer. If you have questions on, well, I think I may have overpaid tax on manufactured machinery, equipment, supplies, computers, electronically downloaded software, you can always file for a refund claim. I can work with you on that process. If you think, oh crap, I haven't been filing a use tax return, I may have a bunch of tax liabilities, we can work through that through the voluntary disclosure programs, which we reach out to the state on an anonymous basis and try to help clean up those liabilities. Process reviews, I can come in and I can look at your processes, talk to your accountants, see what they're doing on sales and use tax, where they think within your manufacturing process the manufacturing stops and starts, and kind of give them a little more guidance on what exemptions they should be claiming, which ones they shouldn't. Nexus reviews. This will likely change after the Wayfair Nexus decision, but going forward after that, you'll need to reconsider where you do have Nexus and where you should be filing. Probably a good exercise after that opinion comes out to really decide what has changed in the Nexus landscape. And then just general training, talking to your folks about their sales and use tax process, what they're doing, what they're not doing, going in and really recommending processes to help them reduce the liabilities and maybe save some money going forward. If you want more information, connect with me on LinkedIn, follow Dickinson on LinkedIn, subscribe to the Iowa Table Salt blog. I try to write maybe twice monthly on that blog. It covers primarily Iowa tax issues, largely skewed toward sales and use tax. I will be putting on 3 more webinars this year. Sales and use tax for contractors, again, that's a very complex issue. I've gotten more requests for that. Defending audits by the Department of Revenue and Appeals. And I'll talk about sales and income tax nexus. And that will be shortly after the South Dakota v. Wayfair decision. You can always email me at my email address there, or feel free to call. If anybody has any questions right now that they would like answered, go ahead and type those in. And if not, I just want to thank you guys for your time. All right, thank you very much.